Thank you. I would like to call this hearing to order and acknowledge that we're in Treaty 1 territory, the home and the traditional lands of the Ojibwe, the Cree, Dakota people, and the national homelands of the Red River Métis. Our drinking water comes from Shoal Lake 40 First Nation in Treaty 3 territory. My name is Ron Merritt. I'll be your chairperson this morning. Introducing the panel members, Miss Linda McFadden and Miss Laurie Davidson. Our recording secretary is Stephen Lunn, and representing the city of Winnipeg from the assessment department is Ryan Vanderama. This morning we'll be hearing the application of revision of the assessment roll according to the Municipal Assessment Act. The matters for which revision is requested has been described in each application and will limit discussions to those matters. The statements that are made at this hearing are sworn testimony, and anybody speaking in these matters must be sworn in. Please be advised that comparisons of assessments of properties are not considered evidence of market value by the Board of Revision. The Board of Revision is appointed annually by City Council and is independent along with the city administration. We make decisions based on the evidence provided at this hearing and issue a written order that will be mailed to all parties as soon as possible. Please note that the board's decision in respect to application may be appealed to the Manitoba Municipal Board if the matter pertains to assessed value or classification, or to Court of King's Bench if the matter pertains to application of exemption from taxation. Should you wish to appeal, information on how to do so will be included in the board's order. In respect to the hearing this morning, I will confirm the points of appeal with your property to be addressed with each applicant following the swearing in. We'll then have the assessor's testimony followed by questions that the applicant may have, and then it'll be the applicant's testimony followed by questions. Each party will have the opportunity to summarize if they wish. Once all evidence about the application has been brought forward, the applicant may leave. The process will repeat for each item on the docket this morning. The session will close after all applications have been heard, and the board will deliberate in private and make its decisions. You will receive the board's decision by registered mail as soon as possible. As information, all public hearings are live stream recorded and will be part of the public record. This morning we'll be hearing items 1 to 10 on the docket. So I asked Mr. Lunn to swear in the assessor and swear in the applicant's testimony. Mr. Lunn?
Mr. Assessor, please state your full name.
Ryan Valderrama.
Do you affirm that the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
I do, thank you.
Thank you. Mr. Applicant, please state your full name.
My name is Jared Story.
Do you affirm that the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
I do.
Thank you.
Thank you.
All right, we'll proceed according to the docket here. So the first one we have is 588 Manitoba Avenue. Mr. Vanderama, whenever you're ready, you can take us through this property.
Thank you, Mr. Chair. The first property has a file number of 22-1981. It has a roll number of 14-020-566-500. The property is located at 588 Manitoba Avenue. We're dealing with the roll year of 2023. Using reference date of April 1st, 2021, the assessed value is $484,000. The property is classified as a residential 2 with a liability of taxable. The property is a residential apartment with 1 building, 3 stories, with an actual year built of 1914 and effective year built of 1957. It has 12 suites with 3 outdoor parking. It is zoned as a residential 2 family with a land area of 7,096 square feet, a planned area of 3,337 square feet, and a basement area of 2,905 square feet. It has a gross floor area of 12,916 square feet. On page 3 is the aerial photo of the subject property. And on page 4 is the income valuation summary. Again, there are 12 units with an average monthly rent per unit of $533.17. The gross potential rent is $76,776. It has a vacancy rate of 3.2%. 3.2%, or $2,457. It has an effective gross income of $74,319. It has an expense ratio of 56.69%, or $42,131. The net operating income comes down to $32,188. It has a capitalization rate of 6.65%. Applying the capitalization rate to the net operating income, the capitalized income is $484,030, or $484,000 rounded. On page 5 are some rent comparables. The first one is located at 283 Mountain Avenue. It has an average monthly rent per unit of $783. The second one is located at 794 Main Street. It has an average monthly rent per unit of $537. And the third one is located at 291 McRae Avenue. It has an average monthly rent per unit of $664. And the last one is located at 310 Redwood Avenue, and it has an average monthly rent of $667. On the next page, page 6, is the map of the subject property and comparable rent. On page 7 and page 8, I do have the capitalization rate chart and the capitalization rate evidence. And for the interest of time, Mr. Chair, I will go through these 2 pages, and I request that these be carried forward to the rest of the properties we're hearing today.
Very good.
Thank you, Mr. Chair. So on page 7, the capitalization rate chart. A direct capitalization method is used to convert a property's single year of income into an indication of value by dividing the estimated net operating income by an appropriate capitalization rate. Capitalization rates can be derived from properties that have sold by dividing each property's net operating income by its sale price. For the 2023 general assessment, using April 1st, 2021 as the reference date, capitalization rates were derived from model-generated estimates of net operating income and sale prices that were time adjusted to April 1st, 2021. The assessed values produced by the application of these model-generated capitalization rates were compared to sale prices, and assessment to sale price ratios were calculated. The resulting ratio statistics for the assessment and taxation department's income-producing model satisfy the standards specified and set forth in the Standard on Ratio Studies, as approved in April 2013, and as published by the International Association of Assessing Officers, or IAAO. ATD's capitalization rates are further supported by comparison with real estate market reports from Colliers International Canada, CBRE National Research, and Cushman and Wakefield. The following chart compares ATD's capitalization rates by fitting ATD's rates into the property type categories used in these reports. ATD's property type classes are more comprehensive so that they cover every property type in the city. The 20th and 80th percentiles show the range of capitalization rates used by ATD for 60% of the parcels within that specific property type. In many cases, the published rates fall within 20th and 80th percentiles, indicating the tenability of the capitalization rates derived by ATD. So if we go further down on the chart, we can see multifamily. All property type class has a range between 20th to 80th percentile of about 4.8 to 5.6%. And on the next page, I do have the capitalization rate evidence. The following is a sample of actual sales that took place during the reference period. The purpose for showing these individual capitalization rates is to illustrate the accuracy of the model and substantiate the model-derived capitalization rate. They are not meant to be comparables specific to the subject property. Net operating income has been developed through stabilizing owner-reported income and expense information. Capitalization rates have been derived by dividing the property's net operating income by its sale price. So the first sale is located at 2390 McPhillips, was sold on October 9, 2020. It was sold for $19.4 million and an average or a calculated cap rate of 4.79%. The second one is located at 700 St. Mary's. It was sold on April 7th, 2020, sold for $1,035,000, and it has a calculated cap rate of 3.6%. Third one is located at 203 Bertrand, was sold on June 14th, 2019, for $925,000, and it has a calculated cap rate of 4.77%. Next one is located at 555 Corridon. It was sold on November 26, 2018. Was sold for $1,575,000, and it has a calculated cap rate of 5.74%. Next one is located at 677 Maryland. It was sold on December 15, 2020. It was sold for $2.4 million, and a calculated cap rate is 5.5%. And the last sale is located at 32 Arden. It was sold on March 1st, 2019 for $2.875 million, and a cap rate of 5.05%. On page 9 up to page 11 is the 2020 income and expense information for the subject property. And that's my presentation, Mr. Chair.
I thank you, Mr. Venturella. Mr. Story, questions of the assessor?
Yes, thank you, sir. I have a few questions, and I'll ask my questions regarding the cap rate presentation carried forward for the balance of the docket, if that's okay with you, Mr. Chair.
Yep.
Okay, wonderful. Mr. Valderrama, can we agree this property is indeed a social housing resource? Is that a fair comment?
Social housing, yeah, just basing it on the ownership, Mr. Chair. I wasn't able to go into the property and inspect it.
Okay, and so I just very quickly, you mentioned the income and expenses. Did you have a chance to review them for the purpose of our exercise today?
Yes, I did.
Okay, and was there any attempt to stabilize those expenses into what we'll call a typical year by looking at the history of the submissions by the owner?
I went with the expense ratio of 56.69%, which is model derived, Mr. Chair, on this one.
Okay, and indeed the entire workup on page 4 here is simply model derived. Is that correct?
Yes, that's correct.
Okay, and this property is well, it was built over 100 years ago. Is that fair?
The year built is 1914. Yes, over 100 years ago.
It was originally built as it's called the European block. It was originally built as well, they had it was steam baths, and then it had apartments on the top, and then it was called Obies in the 70s. Is that 50s to the 70s? Are you aware of the history of this property?
I wouldn't be able to comment on that without inspecting the property.
Okay, can we agree at a minimum it is indeed in the north end?
North end 58. Yes, it is.
Okay. Now on page 7, you've read the this bolted on study. So I just want to ask you a couple of questions. Does the model consider the location of this property?
Location of the property in terms of,
well, if
I believe it is considered in the cap rate.
Okay. And does the model consider the actual year built, or does it draw from the effective year built that's been applied?
From effective year built.
Okay. And can you tell us what gave rise to that change in the effective year built? Was that a subjective decision by an assessor at some point in time?
I am not sure of the particulars, but most likely I would say that it is brought about by extensive renovations that were done in the property.
Okay. And can we agree, though, that typically properties that are reconditioned for social housing are typically built to a more basic standard than the type of properties that we would see renting in the private market? Is that a fair comment?
I am not sure if I could comment on that. I have no information with regard to that one, so no, I wouldn't be able to comment on it.
Okay. Does the model consider social housing? Does it make any adjustments for social housing when it generates the cap rate?
I am not sure how a model reacts on the ownership or the type use on the properties with regard to the cap rates.
Okay. The model generated cap rate, does it consider the property's amenities?
I'm not sure how the model reacts on it.
Okay. And then just one last question about the model generated cap rate. Does it consider parking ratio?
I'm not sure. I don't have any information with regard to the how cap rate reacts on the parking ratio.
Okay. For the second paragraph, it mentions that you talk about sale prices. How many sales were used in the model for this cycle? You're aware?
The total number, I'm not sure. I don't know.
Okay.
It could be a lot.
So in the valuation manual put out by the city, it does indeed suggest that the wider swath of cap rates range from 3.5 to 7.4. Is that correct?
The wider spot, no, I don't have that attached in my evidence, so I wouldn't be able to
It's in our
or comment on it.
Okay, it's in our cap rate study, but it's a document. We can agree that the city puts out every reassessment. It puts out a guide called Valuation of Income Producing Properties, and it shows us some of the parameters that are used. And it does indeed show that the cap rates, not the 20th and 80th percentile, but the full swath of cap rates that the city is suggesting range from 3.5 to 7.4 for apartments. Is that not correct?
If there is that range, then they are all model derived, yes.
Okay. And then you've included the brokers tables here, but just for the purpose of our exercise today, typically the brokers wouldn't include some of these properties. Many of the properties, if not all of them, they would not be considered investment grade properties typically. Is that a fair comment?
I'm not sure how they come up with this with the ranges that they have. All I know is what I have on my paragraphs on page 7.
Okay. All right, and then just go through this once. Cap rate evidence on page 8. I guess the first question is there are no calculations to support these cap rate derivations in this table in chief evidence. Is that fair?
They were not attached on this. However, as indicated, they were the NOIs were all from the income and expense information for these properties that were in here.
Okay. And then for the first one on McPhillips, we've all heard all about this, but can we agree that the rents at the time of purchase were indeed below the MHRC average? Is that your understanding?
Well, I've heard of that question already, and from my perspective, it was the rent being charged during that time of sale or before the time of sale.
So just to be clear, that the rent being charged upon acquisition by a real estate trust, those rents were indeed below MHRC average, correct?
I wouldn't be able to say if it was below the CMHC average, but they were being charged by the previous owner.
Okay, and those rents were raised upon acquisition by that trust. Is that fair? Based on your understanding?
I don't have that information on my brief.
Okay. St. Mary's was purchased with the intention to renovate. You aware of that?
I don't have that info, so I wouldn't be able to comment on that one.
And then just very quickly, that property on Arden, you must be aware, because we've mentioned this in multiple hearings now, that there's some discrepancy regarding miscellaneous income on that property. Is that a fair comment?
It was discussed previously, yes.
Okay. And I think a couple of the others we're not too far apart on. Okay, those are going to be my questions. Thank you, Mr. Chair.
Thank you, Mr. Story. Ms. McFadden?
I have no further questions today.
I thank you. Ms. Davidson?
I have no questions either. Thank you.
Okay. Mr. Vanderama,
Yes, sir.
you've done all the research in regards to all the properties that you've are doing this morning. Have you looked at almost like a common denominator in regards to expenses for apartment buildings that are run or owned by Manitoba Housing? And I look at that, and their expenses probably exceed the norm for apartment buildings. Can you comment on that?
In the market, yes, I would comment that they exceed the norm. However, in our model, we can see that based on my observation, they're they're on the higher side. The expense ratios that are being used, so they are already sort of on the higher side.
So did you find throughout your presentation or your workups on these properties that all of these properties are running above the norm for expenses?
I do believe so, sir.
All right. I thank you.
Thank you.
Mr. Story, your presentation?
Yes, thank you, sir. Just very quickly, I want to address something you mentioned here in terms of, we've heard from the city a number of times that social housing expenses tend to run on the high end, but you're going to see a property that is privately, professionally managed, privately run, where the expenses run high as well. And I would suggest to you that typically when we see properties leasing on, we'll call it the lower end of the range, we do tend to see higher expenses. So I just want to make that point while it's fresh. It's a very good point. Typically, when we see hot rents, you will see obviously higher expenses. So for this property, now again, we're at the corner of McGregor and Manitoba Avenue. This is the high 500s. This is right across from the Ukrainian Labor Temple. This is indeed the north end. This is about as north end as you can get at the corner of Manitoba and McGregor. It was built in 1914. Again, it was Russian or Turkish baths on the main floor. I think memory serves me in my research that ran until about 1970 or so. I know that Obies, who was a sort of a famous North End businessman, acquired it in 1949. That was Jack Oberman, was run as Obies. So it is sort of a iconic building, so to speak, but it's quite old, and the area is, well, it's challenging. So in many cases here today, when we look at some of these older properties in the North End, we'll see cap rates that are sometimes higher than the assessor, sometimes lower. But we've looked at them from a very, very site-specific basis. So know this property reasonably well. I did not have the chance to inspect it for the purpose of this cycle, but I drive past it every day, and I've driven past it every day for many, many years. It's a 3-story building, southeast corner of Manitoba and McGregor. It does have 12 units, 6 one-bedrooms, 6 two-bedrooms. It's being used by WHRC as social housing. It has a very low parking ratio, which would be considered a negative. It is wood frame. It does have basic suite finishes. There is no central air. The bones of this building are indeed 109 years old. It has a stone foundation. It has a low number of suites. So ultimately, we've applied a cap rate at the higher end of 7%. Locationally, again, we do have something of an issue, and the overall age is certainly would give an investor some pause. Now, if we consider the cap rate as the numerical expression of risk, if an investor was presented with this opportunity, I would suggest to you that this would fall on the very, very high end of the scale of risk. On page 15, obviously the rents that are being achieved here are rent geared to income. They're not typical of market. They're low. So we've and actually to the department's credit in this case, the rental comps are quite good. I've looked at them. I think that they are indeed. I think they're bang on. I think those are good comps. So we've accepted the rent. So ultimately, we have looked at these expenses. Now, the expenses do run high. Clearly, they are running at a deficit. They're not achieving economic profit. But I have capped the expenses at 65%, which would represent the higher end of an older building, renting on the lower end of the scale. I have used a 3.2 market vacancy. Vacancy in the city of Winnipeg at the reference date is 3.8%. But if we are using lower rents, then it would stand to reason that when there's a value proposition on the lower end of the rental scale, there should be lower vacancy. So ultimately, our NOI is $26,012. We're using a slightly adjusted cap rate. We think that 6.65 is light for this property. We have considered the location. We have considered the age. We have considered the low parking ratio, and we have considered the fact that it is built to, or it's been converted to a more basic standard for the purpose of fulfilling the mandate of social housing. So ultimately, our value comes to 371,596, which we then round to 372. I have our R&M study for this property. We have fulsome statements from the owner for many years now. You can see the 5-year average calculates to 1,966 per door. That's on page 16. You've all been provided with our cap rate study. I should have mentioned this, but ultimately, when we see social housing, we have some guiding principles that we follow. Where typically, when we have when we find properties in neighborhoods where we can say that the built environment is indeed in decline, that would pose more risk to an investor. Low income tenancy would typically cause a higher degree of let's say wear and tear on the units, and that's supported by the orders that we have here, and the age. So actually, when we talk about the 4 factors that influence the cap rate over and above the market, all 4 are apparent here to a high degree. So again, I'll mention a number of times throughout this hearing, and I'll just say it once, Mr. Chair. We do consider the building type and construction, heritage status. We will have a quick discussion on heritage on at least one of the properties today. The amenities, we do see a tenant preference in the private market for a greater degree of amenities that we don't typically find in social housing, that we certainly don't find on Manitoba Avenue. Age, condition, parking ratios, suite size, number of suites, and of course, location. You've been provided with our sales. Ultimately, these market sales would provide a baseline for us, and then we would make our adjustments upward. For properties that are built in this vintage, we would typically, in the private market, fall somewhere between 6.1 to 6.6%. So we have some extra consideration for certainly for location, and some consideration for the use as social housing. So ultimately, we feel that our value of 372 is supported, and I do ask the board adjust that value for the purpose of this cycle based on our submission. And with that, I'm open to your questions.
I thank you, Mr. Story. Mr. Valderrama, questions of Mr. Story?
I have none, Mr. Chair.
I thank you. Ms. McFadden?
So just to be clear, you use the same rental rate as the assessor did, Mr. Story. You said that you reviewed those. What kind of rents were you reviewing?
The rents that the city has proposed in their submission. We believe that I'm making the comment that those rents are those are properties that are in a very similar location that have similar challenges. So typically, when we see the rents that are generated by the model for social housing, we review them to ensure that they are indeed commensurate as a factor of CMHC. But I've looked at the actual rental comparables that the city has suggested here today, and I noticed there's one on Redwood that I thought was quite good, and there's one on Main Street that I also think is quite good. So I think those comps are good, and I think that the rental rate is appropriate. We generally, in most cases, accept the modeled rent on social housing because it does typically consider a downward adjustment from CMHC. So that's why, and ultimately, it's a great question. If we look at the actual rents being achieved, of course, they're typically 30% of the tenant's income, so they would be much lower. They wouldn't be appropriate to use. They would be too low.
Really, my question was sort of how they lined up with the CMHC.
Oh, yeah. So, well, I don't have the table here, but I do have it in another brief. So I think that if we're in and around that, it's about 500 per door or something like that. But these are larger suites. So sorry, I don't have that in front of me, but we did review them prior to our submission. So I don't have the table in front of me right now, but they do seem to be in line with what we'd expect.
That's really all I wanted to know, was whether you'd look at the CMHC.
Okay.
Yeah, thank you.
Thank you. Ms. Davidson?
I just had a really quick question, and I'm sure you said it and I missed it, but in terms of choosing the 7% cap rate, which is highest, I'm looking at your page on cap rates, like based on age, construction. And then I'm looking at the little table on the various market reports. So you're drawing 7 from a base and then you added, is that what you said?
Precisely. Yeah. So if we look at our, so we have our full cap rate study, but the summary of our cap rates are provided in that little table. So if you look at that top entry, it says before 1946. So this is for the older stock. We typically, and this is for good properties and good locations, we would typically make a subjective decision, to be fair, between 6.1 and 6.6. But those are properties that would not, we would not typically have the same locational issue here, and we wouldn't have the same, we would adjust upwards for social housing. And that's, so that's the reason for that. So social housing, we take the a baseline market capitalization rate, and then we consider site-specific factors, and you'll typically see an adjustment between 0.5 point and 1 full point, depending on the property in question. So in this case, we do have a property that is very old, but it has been, it's been reconverted. The city is suggesting 1957, but ultimately we have this building from 1914. I think considering that the bones of the building are over 100 years old, and considering the location, the parking issue, and the fact that it is used as a social housing resource, 7% is appropriate, just to reflect the higher degree of risk from a market perspective.
Okay, thank you very much. I have no other questions.
Well, thank you. Mr. Story, can you explain, and I know it's a tough question, why expenses run so high? You've done, apartment buildings, and do you find like social housing run a certain percentage over the norm for expenses? Like this one here is like 65%. I mean,
yeah, it's high, but it's also it's a building that's over 100 years old. So yeah. That's a question. I'll show you. Okay, so this is a great question. I'd like to actually speak to this. So when we look at our stabilized workup here, the insurance is going to be what the insurance is, regardless of the ownership or tenancy. The management fee is 5% of EGI. That's a market standard. Of course, wages, benefits, sundry, miscellaneous. That's going to be relative to the property. That those don't typically run high, but we do on occasion see that the utilities run high. Now, I'd made mention of this. These are running at 22.9% of EGI. So that's on the fairly high side. We would probably expect in a private market to see maybe 17 or 18%. But the property is older, it's less efficient, and it's because it's not achieving economic profit. Maybe some of those systems are less efficient. So typically, where we see the real delta in the expenses would be where it's most sort of obvious would be in those expenses. But I do caution that they're a touch high, but they're not completely out of whack. So and the ratio, of course, is based on the fact that the income is would be low, and the income that's being applied here is on the lower end. So when we look at those actual ratios in that subject stabilized percentage per square foot column, the utilities are the ones that jump out at me here. But again, we have a much newer property on Church and Charles, and they're running it at, I think it's 18.6. We'll see it later today. Typically when we see hot rents, so when heat and water are included, those tend to run higher. But that's in social and in the private market. So it might be a question more of the hot rents versus a social issue, but it's a good question. So yes, we do tend to see them run a touch high, but we also have to consider the age and other factors. So I hope that answers your question.
Yes,
it is a bit of a tough one. Yep.
Yes, it does, Mr. Story. I have no further questions. Either party wants a summation?
I have none, Mr. Chair.
I am good, sir. Thank you.
All right. Let's move on to the next property, which is just a little further down the street, 347 Manitoba Avenue. Mr. Assessor, whenever you're ready.
Thank you, Mr. Chair. Next property has file number of 22-1976. The property has a roll number of 14020416500. Property is located at 347 Manitoba Avenue. We're dealing with the roll year of 2023 using reference date of April 1st, 2021. Assessed value is $1,012,000. Property is classified as a residential 2 with a taxable liability. The property is a residential apartment with 1 building, 3 stories. It has an actual year built of 1915 and an effective year built of 1940. It has 18 suites with 10 outdoor parkings. It is zoned as a residential 2-family with a land area of 13,814 square feet, a planned area of 6,261 square feet, a basement area of 6,009 square feet, and a gross floor area of 24,540 square feet. Page 3 is the photo of the subject property. And on page 4 is the income valuation summary. Again, there are 18 units with an average monthly rent per unit of $728.33. The gross potential rent is $157,319. The vacancy rate applied is 3.2%. or $5,034. It has an effective gross income of $152,285. Expense ratio for this property is 55.13% or $83,955. The net operating income comes down to $68,330. Applying the capitalization rate of 6.75% on the net operating income, the capitalized income is $1,012,000 and $296 or $1,012,000 rounded. On page 5 are some rent comparables. The first one is located at 123 Sutherland Avenue. There's an average monthly rent per unit of $777. The second one is located at 183 Euclid Avenue. It has an average monthly rent per unit of $1,036. The third one is located at 229 McRae Avenue. It has an average monthly rent per unit of $878. And the last one is located at 259 Church Avenue. It has an average monthly rent per unit of $814. On the next page, page 6, is the map of the subject property and comparable rents. And on page 7 is the capitalization rate chart. On page 8 is the capitalization rate evidence. Beginning of page 9 to page 11 is the 2020 income and expense information for the subject property. And that's my presentation, Mr. Chair.
I thank you. Mr. Story.
Yes, Mr. Valderrama, this, once again, this is a social housing property, correct?
Based on the ownership, yes.
Okay, and it's, once again, we're in the north end, correct?
Yes.
Okay, and this model, or this value today is all model derived, correct?
On my page 4, yes, they're all model derived parameters.
Okay. Okay, I think, one question for you, sorry, and I think this one pops up a number of times. I mentioned that I thought some of these rents were good, but I looked at this one on Euclid. Can you confirm that that's a private rent?
I wouldn't be able to confirm, no. I don't have that information here.
Okay, all right, that one just stood out to me and I looked into it. I thought that was a bit odd, but that's fine, that's okay. Thank you, Mr. Valderrama. Those are my questions, Mr. Chair.
I thank you. Ms. McFadden.
No further question.
Linda, I didn't quite hear that. What?
Sorry, I have no further questions.
Okay, I thank you. Okay. Ms. Davidson.
I have no questions either. Thank you.
Mr. Story, again, social housing expenses running at 65%.
Oh, I'm sorry. Are you asking Mr. Valderrama? I haven't given my presentation.
Sorry.
Yeah.
Sorry.
But you're right. We'll talk about it in a second.
Okay. I have no further questions. Mr. Story, your presentation.
Yes, thank you, sir. Okay, so here we are. We're still on Manitoba Avenue, but now we're in the mid 300 block, and this would be Manitoba and Aikens. It's a 3-story apartment building. It is built in 1915. It has a mix of one bachelor suite, 5 one-bedrooms, and 4 2, 3, and 4 bedroom units. So that's 18 units in total. Now we've just to cut to the chase here, we have accepted the 6.75 cap rate for this property. I guess the previous one, well, it's a conversion, so we do consider that. This is simply an older apartment building, but it is, once again, 96 years old. We're not arguing the cap rate in this instance, and we have accepted the rents as per usual course. You can see the actual, call them the gross rents that are being achieved here are much lower than what we would expect on the market. The vacancy at 3.2% applied by the model is accepted, though again I do caution that that is on the very low end of what we're seeing. So ultimately, this comes down to the expenses, 65% capped again. Now, in terms of just further to our discussion, you can see that well, insurance is what it is. The 5% management in this case is actually lower than what's being reported by the owner. And again, those utilities run on the higher side for the private market, but they're only a touch higher than what we'd expect for hot rents, renting at the lower end of the register, so to speak. The stabilized R&M on a per suite basis is $1,704 per door. So ultimately, our total expenses come out at fairly high, but we've capped them here at $98,985. That represents 65%. We think that the 55% that's been generated by the model is too low and is not considered the site specifics. Again, we've stabilized these and then capped them to ensure that we're not overstating. So ultimately, our NOI becomes $53,300. Cap rate is not in dispute at 6.75, and our value then is calculated at $789,625. Again, that's an NOI of $53,300. With an indicated 2023 market value of $789,625, which we then round to $790,000. The support for our R&M is on page 12. So in cases where we have full sets of financials, we're able to perform this exercise, and so that's all been provided to you. Obviously, we take out any inappropriate items that are submitted. We put them by, we've itemized them here for you. Backed out the waste and snow, as those are, that's a separate line item, so as to not double count. You can see indeed that the R&M per door here is $1,704. So we do again respectfully submit that the value for this property not exceed $790,000. And with that, I'm open to your questions.
Thank you, sir. Mr. Vanderema, questions?
I have none, sir.
I thank you. Ms. McFadden?
I have no further questions.
I thank you. Ms. Davidson?
This is just a minor clarification. You're indicating a different mix of bedrooms than the assessor is. Like you're showing three bedrooms, 8 of them, versus he's showing 3 bedrooms, 4, and 4 bedrooms, 4.
Oh,
Just curious.
yeah, no, I didn't see that. Oh, you know what? It should be 3 bedroom plus. So that's how CMHC categorizes anything over 3 bedrooms. So on my page 2, where it says 8 3 bedrooms, it should be 4 3 bedrooms, 4 4 bedrooms. And I think that's in here sort of narratively, even it's in a bit of a, right. Yeah. 4 each of 2, 3, and 4. So yeah, no, that's correct.
And just to clarify for myself, there's no suites in the basement, are there? That's a
question. That is, well, I think there is actually. If you look at the photo on the last page, you can see that there are windows that are just at grade. So typically that would indicate to us that there would be. I haven't been inside this building, so I can't say for certainty, but my guess would be that there would be. But
okay.
That looks to be the case. There are those windows down there. So
Okay, thank you very much. That's all my questions.
Thank you. Either party wants summation?
I don't know, Mr. Chair.
We are good. Thank you, sir.
Okay. Let's go to the next one, which is 145 Powers Street. Mr. Vanderama, whenever you're ready.
Thank you, Mr. Chair. The next property has a file number of 22-1597. The property has a roll number of 140-102-41100. The property is located at 145 Powers Street. We're dealing with the roll year of 2023 using reference date of April 1st, 2021. The assessed value is $4,455,000. The property is classified as a residential 2 with a liability of grantable. The property is a residential apartment with one building, 12 stories. It has an actual and effective year built of 1975. It has 100 suites, 30 outdoor parking. It is zoned as residential multi-family. It has a land area of 13,937 square feet, a planned area of 5,014 square feet, and a total gross floor area of 56,728 square feet. Page 3 is the photo of the subject property. And on page 4 is the income valuation summary. Again, there are 100 units with an average monthly rent per unit of $588.73. The gross potential rent is $706,476. The vacancy rate is 3.2% or $22,607. The effective gross income is $683,869. The expense ratio is 56.68% or $387,617. The net operating income comes down to $296,252. Applying the capitalization rate of 6.65%, the capitalized income is $4,454,917 or $4,455,000 rounded. On page 5 are some rent comparables. The first one is located at 423 Burroughs Avenue. It has an average monthly rent per unit of $556. The second one is located at 950 Burroughs Avenue. It has an average monthly rent per unit of $730. The third one is located at 200 McGregor Street. It has an average monthly rent per unit of $716. And the last one is located at 330 Mackenzie Street. It has an average monthly rent per unit of $740. Next page, page 6, is the map of the subject property and the comparable rents. On page 7 is the capitalization rate chart. On page 8 is the capitalization rate evidence. And beginning of page 9 up to page 14 is the income and expense information for the subject property. And that's my presentation, Mr. Chair.
I thank you, sir. Mr. Story, questions?
I have some questions. Yes, thank you. Okay, so again, Mr. Valderrama, this is so it's owned by Manitoba Housing and it's managed by Winnipeg Housing. So we can rightly confirm this is social housing property. Is that a fair comment?
Just based on the ownership, yes, I would agree on that one.
Okay, and you say there's 30 outdoor parking stalls. Where does that number come from? So I have 10 on file. I'm just wondering where the model or where the city's getting 30 from.
It's been on our file ever since, so I'm not sure when it was entered. But probably it's been there.
Okay. Have you ever driven past this property or sort of had a look at it, photos, anything like that?
No, just the photos of it.
Okay. And can we agree? It has a Powers address, but it is indeed, it's in the high 400 block of Selkirk Avenue, is it not? Physically. It's at the bell tower.
On my picture, it says Selkirk Avenue on the on one of the streets and Powers on the other side.
Right. Okay. Okay. And just very quickly, because we are going to talk about rents in this context. Here's my other question. This property has some common area in it, correct? You can see, I think, that atrium type area on the main floor. Is that correct? There would be some
I
common
don't have
area.
the interior photos.
Okay. Okay, but just so we're very clear though, the calculation of the gross floor area per unit at 567, just mathematically, that's a function of dividing the gross floor area of 56,728 by the number of units, which you have here is 100, correct?
Yes, that's correct.
Okay, so any common area then is going to be, it's going to present a gross floor area per unit that is higher than the actual physical space, correct?
It may, yes.
Okay, and these are, we can agree just as a general principle, these are very small suites, correct?
Not sure. I haven't been in the property, so no, I don't know.
Okay, and it's simply a model generated assessment, correct?
Yes, correct.
And did you look at the CMHC table in this case to, based on the size of these suites, did you look at the CMHC table to determine if these rents were indeed in line with the area and then the size of the suites and some of these specific factors, or is it just simply model derived?
It is model derived, and I'm just comparing it to, or just looking at the rent comparables on page 5. It's on the lower end.
Okay. And just, sorry, very quickly, last question. These are much larger suites. That one on 200 McGregor, those are over 1,000 square feet per unit. You're suggesting Mackenzie is similarly very close to 1,000. So these are on the much lower end, correct?
These are all in the, they have a bigger gross floor area per unit.
Right. And typically, just as a general principle, would you agree with me that larger suites tend to command a higher rental rate on the market? Is that a fair comment?
I couldn't comment on that because I've seen some smaller ones that are commanding higher. So I wouldn't be able to comment on that or agree on that statement.
So just as a general principle, if all other things are held equal, if they're the same condition, same area, do you not think that a larger suite would typically drive a higher rental rate?
Again, same answer.
Okay, those are my questions, Mr. Chair. Thank you.
I thank you. Ms. McFadden?
So I think following up on the same line of questioning, looking at your comparables, there's only one other comparable that has any bachelor suites at all, and it has only 2. This particular building is 77 bachelor suites.
Correct.
So that would lead you to think that the rent could be low on the lower, much lower than a 1-bedroom or a 2-bedroom suite. Correct?
That's correct, ma'am.
Okay.
I thank you. Ms. Davidson?
My question's been answered. Thank you.
Okay.
Thank you.
I have no questions. Mr. Story, your presentation.
Yes, thank you, sir. And Mr. McFadden, thank you very much for pointing out the suite count here in the assessor's comps. In my haste, I neglected to mention that. But yes, of course, mathematically, when we have a higher count of 2-bedroom units, of course, that's going to bring that average up. So thank you for bringing that up. I neglected to mention it. Okay, so again, we have a property that's owned by Manitoba Housing. It's managed by Winnipeg Housing. The street address is 145 Powers, but as I mentioned, it is in the call it the high 500s, or sorry, it would be in the high 400 block of Selkirk Avenue. If you know Selkirk Avenue, it's right by the bell tower. This is this little courtyard outside of this building is the sort of the north end landmark, the bell tower. So that's where we are here, despite the fact that we have a specific address on Powers. It is a 12-story high-rise. It was built in 1975. It is zoned RMFL. Now, this is very interesting. The property contains 77 bachelor/studio suites. Typically, when we see studio suites, that indicates to us that these are smaller. These are on the very small side, with only 22 1-bedroom units. I mentioned in my initial on the first file, Mr. Chair, just to reference back, that we do consider the suite mix Clearly, we have to consider the type of income that we're going to generate based on the sizes of the suites and the types of suites, and we should probably consider that in the cap rate as well as a risk factor when we look at the potential durability of the income and the capability for the income to appreciate over time. So certainly, we have to consider the fact that these are atypical from a market perspective. And of course, our exercise here today is to look at this property through the eyes of the market. So I will suggest to you that we actually have 10 parking stalls on record. There are not 30. I think they could probably maybe squeeze in 12 there based on my overhead photo, but it's certainly not 30. So we have a very, very low parking ratio, and for a high rise, that's not typical, and it's not totally typical in outside of the downtown, let's say. So that would be considered something of a negative factor. Of course, locationally we have some challenges. I mentioned that we would typically consider the rents. Well, we would not generally argue with the rents applied by the city if we believe that they were indeed a factor of CMHC, but in this case they don't appear to be. So I've provided you with a calculation on page 9 based on the fact that these are studio or bachelor or one bedroom suites. I've used a factor of 75% of the CMHC table. The CMHC table here is included, and that is of course in the Lord Selkirk area. So we've included that here. So I have an error here under market total. Those are, I'm not sure how those calculated, but it should be the actual rents. The actual rents in the area as per CMHC are $644 for studios. Typical one bedrooms are $764. We have 99 suites here. That's what we have from the owner. WHRC confirms this on the back of my brief. So we've used 99 suites with a factor of 75% of CMHC. There are some renovated properties in the area where the rents will likely be a touch on the higher side, and we have to consider that these are very, very small suites. So that is how we've come to our potential net market income of $637,402, our gross rent. Again, 3.2% at the low end of the vacancy scale we believe is appropriate. We've used the same figure for the expenses, leading us to 62.8. That is a touch below that 65% that we might expect to see, given the location. And then 56.7 is what the city is suggesting. So we're not worlds apart in terms of expenses here. So ultimately, our NOI is the delta that's occurring here is based on the fact that we're using a factor of CMHC rents, and we've not adjusted the cap rate in this case. So at 6.65, that's within range. It may be on the lighter side, but ultimately the resulting value makes sense at $3,449,440. Again, that's based on an NOI of $229,388, and again, the substantial point of contention here is indeed the net market income. We think that that's slightly too high. At 706, we applied 637. So ultimately, we do feel that a value of $3,449,000 is appropriate, and we do respectfully submit that it ought to be adjusted to capture some of these site-specific issues for this property. And the balance of my brief again is just some information. Let's see. So we have, yes, and again on page 25, you see the current listing from WHRC suggesting that we have 78 studio and 21 one-bedroom suites, and that they are all indeed rent geared to income or subsidized. And there's a photo of the bell tower that I mentioned. There's that atrium on page 26. So I haven't had the opportunity to visit the property on the inside, but I did actually speak to the property manager not long ago. So I feel like we have a pretty good sense of this property. So those are my comments. Again, we're suggesting a value of no more than $3,449,000, and I'm open to your questions. Thank you.
I thank you, Mr. Story. Mr. Valderrama.
I have no questions, Mr. Chair.
Thank you. Ms. McFadden.
Mr. Story, would you not agree that 78 bachelor units that a building of this type is generally directed at low-income seniors?
Yes, this one is, to be certain. Yes, it is.
So in that case, the fact that there's only 10 parking spots is probably not as huge a deficit as otherwise you might otherwise expect if it was all families or.
Yeah, I would certainly agree. It's typically single occupancy type units, and yes, you are quite right. It is geared to a niche population, and we did not adjust our cap rate upward from. We're not arguing the cap rate, but I suppose the argument could be made that from a market perspective, that lack of parking would be seen as a negative. But I appreciate your comment. I think you're completely right, and we haven't made an adjustment on that basis.
Okay, thank you.
I thank you. Ms. Davidson?
I have no questions. Thank you.
Thank you. Mr. Story, I note that there's no difference between your cap rates and your gross incomes are exactly the same. The only difference is NOI, and that's applicable to expense ratio.
Well, no, for this one, sir, our gross rents are different. For this one, we looked at it and we thought, when we review the assessor's potential net market income. So this is on line 3 of my page 11. You can see that the model is suggesting 706,476.
Sorry, I made a mistake.
No problem. No, it's okay.
Yeah.
And we've done this simply by because these suites are so small, and Ms. McFadden has quite rightly pointed out, these are these are tailored to low income seniors. They're smaller suites. So when I look at the market rents that are being applied here, I think they're too high, quite frankly. So we've looked to CMHC and made an adjustment downwards. Typically, that's what we see from the city when it comes to social housing, but for some reason, this one struck us as out of sorts. So that is the basis for that adjustment, sir.
Okay. Yeah, I just misread my notes here. I think the expense total is exactly the same.
Yes, we've not disputed that. It looks to be in line. It's 62.8%. That's what we would expect to see.
Yeah, but I'm saying the dollar value is 387,000, right?
Yep. Yep, we've accepted that. You're correct. Yep.
Summation, either party?
I have none, Mr. Chair.
No, we are good, Mr. Chair. Thank you.
All right, let's press on to 740 Selkirk, and we'll do this one, and then we'll take about a 10-minute break after this. So, Mr. Valderrama, whenever you're ready.
Thank you, Mr. Chair. The next property has a file number of 22-1601, has a roll number of 14010728100. The property is located at 740 Selkirk Avenue. We're dealing with the roll year of 2023 using reference date of April 1st, 2021. The assessed value is $763,000. The property is classified as a residential 2 with a liability of grant. The property is a residential apartment with 1 building, 3 stories, has an actual and effective year built of 1986, has 12 suites, 4 outdoor parking, is zoned as commercial community, with a land area of 10,923 square feet, a planned area of 4,016 square feet, basement area of 4,016 square feet, and a gross floor area of 14,744 square feet. On page 3 is the photo of the subject property. And on page 4 is the income valuation summary. Again, there are 12 units with an average monthly rent per unit of $728.29. The gross potential rent is $104,874. It has a vacancy rate of 3.2% or $3,356. It has an average, the effective gross income is $101,518. Expense ratio is 53.8% or $54,617. The net operating income comes down to $46,901. Applying the capitalization rate of 6.15%, the capitalized income is $762,618 or $763,000. On the next page, page 5, are some rent comparables. The first one is located at 123 Sutherland Avenue. It has an average monthly rent per unit of 777. The second one is located at 600 Charles Street. It has an average monthly rent per unit of $748. Third one is located at 620 McGregor Street. It has an average monthly rent per unit of $896. And the last one is located at 259 Church Avenue. It has an average monthly rent per unit of $814. On page 6 is the map of the subject property and comparable rents. On page 7 is the capitalization rate chart. On page 8 is the capitalization rate evidence. And beginning of page 9 up to page 13 is the income and expense information for the subject property. And that's my presentation, Mr. Chair.
I thank you. Mr. Story, questions?
Yes, thank you very much. Mr. Valderrama, have you ever visited this property? The sense of the
No, I
area?
haven't.
Okay. Now, one thing I noticed, and I'm just noticing this now, these would typically be considered row houses, would they not?
No, it looks like this.
Okay, and on page 1 under parcel use, you've got ResApp, but the city does indeed have a different use code for row houses, do they not? CMRRW or something like that.
There is a different parcel use code.
Okay, and does that affect the cap rate in the model?
I am not sure how the model reacts, or in terms of the cap rate, I'm not sure how the model reacts to it.
Okay. All right. And then I guess obviously the only other question here is that this is all model derived, correct?
Yes, on page 4, they're all model derived.
Oh, the value is just model derived, correct? Okay. And then yeah, you know what? I think those are my questions. Thank you, Mr. Chair.
Thank you, Mr. Story. Ms. McFadden?
I have no further questions.
I thank you. Ms. Davidson?
I have no questions either. Thank you.
I thank you. Mr. Story, your presentation?
Yes, sir. Thank you. Okay, so here we are at 740 Selkirk Avenue. These are indeed row houses. This is the corner of Selkirk and Parr. It's the north end. Once again, I think all of our properties today are going to be in the north end. So ultimately, we have a wood frame row house. I mentioned that we talk about in our cap rate study building type and construction. We typically apply an adjustment. We apply an adjustment for row houses, and the reason being is that they are not as efficient. They are more costly to maintain. They have their own individual systems. So we do differentiate commercial row houses from apartments, and the city typically does too, but it would appear that in this case they did not. So ultimately, we are applying a cap rate of 6.75%. Now we have to consider the location. I'm well familiar with this stretch of Selkirk Avenue. This would be a challenging stretch. The general built environment would be considered in a state of decline. To be fair, we do have once again a wood frame row house. It's social housing with no amenities. It's 36 years old, but it does not have a history of economic profit. And we do consider that the low number of suites would not typically be a positive in the eyes of the market. I'd mentioned that we stabilize our expenses when we have full income and expense reports. We don't have all of the full data here, but the rents look to be reasonable, fairly reasonable given the area. They would be typical. That would be fairly low, but given the area, I think that makes sense. Those expenses are also probably on the low side, but we've accepted them based on the fact that we don't have better data at this stage. So all of the risk that would be attributed to this property in the eyes of the market is captured in our eyes in the cap rate. So we're at 6.75, which I think is quite fair, if not somewhat optimistic. So ultimately, we will respectfully submit the value not exceed 694,830, which we then, and again, that's based on the same NOI of 46,901, but adjusting that cap rate to reflect the fact that it is commercial row housing. that the location would be considered a challenge, low number of suites, and quality of construction. So again, ultimately, we feel very comfortable at a value of $694,830, which we then round to $695. Again, some of the decisions regarding social housing are included here, but those are there for your perusal at your leisure. And ultimately, we do feel that $695 is appropriate in this case, and I'm happy to take your questions. Thank you.
I thank you, sir. Mr. Vanderrubbe.
I have no questions, sir.
I thank you, Ms. McFadden.
Looking at your page 9, Mr. Story, can you tell me what your starting point is, what your base cap rate is for this particular building?
Sure. So if we were looking to good quality construction in a good location, we would typically start in and around that 5.5. That's for a regular apartment. We would likely adjust by quarter point for row housing. So we would probably start, if this property were a market apartment, amenity rich, with a higher degree of finish in a location that was not challenging, we would likely start at about 5.75 or so. So we've adjusted it by one point from what we would typically consider our baseline.
Okay, thank you.
I thank you, Ms. Davidson.
No questions, thank you.
I have none. Summation, either party?
I have none, Mr. Chair.
We are good, Mr. Chair. Thank you.
All right. Are we ready for a break here? So let's take a 10-minute break and we'll be back at 10:21. All right, ladies and gentlemen, we'll call a hearing back to order, and we're going to go to 405 Burroughs Avenue. Mr. Valderrama, whenever you're ready, you can take us through this property.
Thank you, Mr. Chair. The next property has a file number of 22-1911. It has a roll number of 14030341000. The property is located at 405 Burroughs Avenue. We're dealing with the roll year of 2023 using reference date of April 1st, 2021. The assessed value is $1,015,000. The property is classified as a residential 2 with a taxable liability. The property is a residential apartment with 1 building, 2 stories. It has an actual year built of 1911, effective year built of 1970. It has 14 suites with 1 outdoor parking. The property is zoned as residential 2 family. It has 9,008 square feet of land area, a planned area of 6,184 square feet, a basement area of 5,986 square feet, and a gross floor area of 18,354 square feet. On page 3 is the aerial photo of the subject property. And on page 4 is the income valuation summary. Again, there are 14 units with an average monthly rent per unit of $765.28. The gross potential rent is $128,567. It has a vacancy rate of 3.2% or $4,114. The effective gross income is $124,453. The expense ratio is 46.99%, which is also $58,480. The capitalization rate of the net operating income comes down to $65,973. Applying the capitalization rate of 6.5%, the capitalized income is $1,014,969 or $1,015,000 rounded. On page 5 are some rent comparables. Again, there are 4. The first one is located at 123 Sutherland Avenue. It has an average monthly rent per unit of $777. Second one is located at 259 Church Avenue. It has an average monthly rent per unit of $814. Third one is located at 790 McPhillips Street. It has an average monthly rent per unit of $852. And the last one is located at 229 McRae Avenue. It has an average monthly rent per unit of $878. page 6 is the map of the subject property and comparable rents. On page 7 is the capitalization rate chart. On page 8 is the capitalization rate evidence. And beginning of page 9 up to page 10 is the 2020 income and expense information for the subject property. And that's my presentation, Mr. Chair.
I thank you, sir. Mr. Story?
Yes, sir. Thank you. Okay, very quickly, Mr. Valderrama, this workup, this assessment is all model generated, correct?
Yes, correct.
Okay, and it is social housing property. Is that correct?
Based on the ownership, I would say yes.
Okay, and you're aware that it actually has a heritage designation as well?
No, I'm not aware of that.
Okay, can we agree though that the heritage designation, that when there's a heritage designation on a property, there's a caveat on title? Is that correct?
I did not look at the title, so I wouldn't be able to comment on that.
Does the model consider the heritage designation or the caveat on title when generating a cap rate for the property? Would the model be able to, would the model know, so to speak, that this is an element of this property?
I'm not sure how the model would react if there is a heritage designation on the property.
Okay. Did you look at the the income and expenses over the last number of years for this property?
I looked at only the 2020.
Okay, so there's no attempt by the department to stabilize the actual expenses on a site-specific basis. Is that fair?
I went with a model on this one.
Okay. Okay. I think, Mr. Chair, those are my questions. Thanks.
I thank you. Ms. McFadden?
I have no further questions.
Thank you. Ms. Davidson?
I have no questions, thank you.
I thank you. I have none. So, Mr. Story, your presentation.
Thank you, sir. So we have once again a social housing property. It is indeed a heritage property. It's the St. John's Manitoba Telephone System, St. John's Exchange, I believe it's called. I have some information here, and as I mentioned, the heritage designation leads to a caveat on title, and that means that any work to be done to this property goes through a separate permitting process pursuant to a different bylaw. So it is important to note that there should be some consideration for a heritage designation. In this case, the protected elements are the facades, and that's again I've got some work here on that for your perusal. But suffice it to say, the property does indeed have a heritage designation. It's on the corner of Salter and Burroughs. Once again, we have some issues with the location, and the property is indeed built. Well, it's built in two stages. The initial building was between 1910 and 1911, with an addition on I believe it's the west side in 1946. So we have a property where the bones of the building are indeed older. It is wood frame. We don't have a history in the what we'll call the modern era of economic profit, and again, we have that low number of suites. So ultimately, we would likely apply a cap rate of about 6.5 on this property, but we do have to consider the heritage designation, and we certainly have to consider the location. Page 11 shows the workups. Now, you can see that the potential gross rents here that are being recorded are extremely low. We have deferred to the model. They don't seem completely out of sorts, so we've used them. We have used the actual expenses. You'll note here that there's nothing here that's really that would jump out at you as an atypical expense. Mr. Chair, you mentioned earlier if social housing typically runs on the higher end, and yes, sometimes they do. But in this case, you can see that the utilities actually for this age of property are running relatively low at only 16.3%. I believe that in this property, the tenants are responsible for electric heat. I saw that in my notes. But regardless, the expenses are running at 16.3% of EGI, which is not atypical. And everything else is basically in line with the market. The stabilized R&M is $1,402 per door. You can see we've provided you that stabilization on the next page. That's page 12. So that's all itemized for you, supporting our request of an R&M of 1,402 per door. So ultimately, the expenses that are being submitted here by the assessor, I think it's likely because they've applied they've applied a variant age of 1970 to this property, and as we've learned here today, it seems that the cap rate and I guess all of the other factors that make up the modeled assessment pull from the effective age or the variant age, as opposed to giving some consideration to the actual age of the property, and it is indeed it's over 100 years old. So the expenses here are calculated at 60.2%, giving us an NOI of 49,510. Again, our cap rate is slightly higher than the assessor in this instance at 6.75. And that's largely to account for the property's use as social housing, for the location, to be certain, and for the heritage designation. So ultimately, with all of those factors taken into consideration, our resulting value is $733,487, which we then round to $733,000. The balance of my brief, well, starting on page 16, you can see the building details. You can see the original age is indeed 1911. It is indeed wood frame. The heritage designation. Now, this is from the City of Winnipeg's heritage. It's called the list of historical resources. This is the entry for the Manitoba Telephone System St. John's Exchange, our subject property. And you can see that the interior elements are not protected, but the facades are indeed protected on all four sides. It was designated in 2018. So this is after the grade system. So in this in the modern era, we use the character defining elements as opposed to the overall grading. So in this case, you can see the facades are protected. We have the short form write up from Heritage. We have support for our cap rate adjustment for affordable housing. And then, once again, should just go through this once very quickly. On page 31, you can see when we have these income and expense mailers, those red notations are ours, and you can see how we come up with our R&M study with those itemized entries. That's all there for you. And I guess the rest of it is just sort of showing some street views of the neighborhood, again, corner of Burroughs and Salter. So ultimately, that's my presentation, and we do respectfully submit the value not exceed $733,000. And with that, I am open to your questions. Thank you.
I thank you, sir. Mr. Valderrama.
No questions, sir.
Thank you. Ms. McFadden.
Mr. Story, I'm looking at page 4, the overhead view of the building.
Yes.
Salter's to the west, Burroughs is to the south.
That is correct. Yep.
Indicated that the building had an addition in 1970.
Oh, 46.
What that is?
So, sorry, it's in 1946. If you look at that roof line on the eastern side,
right?
That's the 1946 addition. So it's built in 1910. That addition is built in 1946. The city is suggesting an overall effective age of 1970. That was the comment about 1970. But indeed, the original property was built in 1946. And from my research, I think it's in my notes here that they talk about the addition in 46. So, and that is actually, if you go to page 18 of my brief, you can see that on the right side of the east addition. So Samuel Hooper built the original building in 1910, and then Northwood and Chivers built the east addition in 46. Yep.
So it's a really small proportion of the building.
It's a small portion. Yeah.
Okay, thank you. That helps a lot. Thank you.
Thank you. Ms. Davidson.
Yes, just on the building itself, what was it that brought it up to a 1970 effective value?
I'm not sure. That's a question for the assessor. We see this property as it's built at 10 years after the turn of the 20th century. It's over 100 years. So I'm not sure how the department calculates their variant age. From our perspective, the bones of the building are indeed built in 1911. So I'm not sure what gives rise to that variant age. I believe, from my understanding from these hearings, the department inspects them, and then I think, from what I understand, makes a subjective decision. But ultimately, we would, well, the building is clearly much older than that, so that's a subjective opinion, and that affects the model, which is why we, part of the basis of our appeal here today.
And have you been in the building? Like, have you inspected it?
No, but I've seen photos of the interior. I think it's in reasonably good shape in the interior, but the location is, well, let's say it's challenging.
So primarily the location and the age.
Location and the actual age of the structure and the heritage designation. That's what would give rise to a slightly higher cap rate than, well, we may be as high as 7%, but I think 6.75. Ultimately, we don't want to adjust the cap rate so high that it distorts the value. So I think we've done a reasonable job of capturing all of the site specific issues and applying an appropriate cap rate.
And you've talked about, as others have, about investment properties. So do you consider this an investment property or just an apartment?
Well, I don't think it would be considered an investment property. I think we have no parking. We have a pretty substantial locational issue. We've got a much older building. It's a property that's been converted, which is not typically desirable in the eyes of the market. So it functions well, from what I can understand, as a social housing property. But in terms of a private market investor viewing this property, I think that they would certainly not say it's an investment grade property, and they would certainly I think they would see it as carrying a very, very high degree of risk.
Okay, thank you very much. That's everything.
I thank you. Mr. Story, based on the pictures, it looks like a fairly nice building.
Yeah, no issue with the exterior condition. But again, if you drive through this area, as I do on a almost pretty regular basis, you know that Burroughs and Salter, the surrounding area, has some pretty there are some serious challenges. So yes, it's a nice heritage building. I'm glad they were able to repurpose it for this purpose, but location is an issue. Heritage designation, of course, as a caveat on title, is an issue, and the age. There's no getting around the fact that the building is over 100 years old.
And expenses run high. They're 60%.
Well, again, I'm careful to say they run high in this building. They're high for a building of this age. I actually think that the utilities are quite reasonable. I mean, the insurance is what it is. And I guess, to be fair, in certain areas, sometimes we see higher insurance premiums. That's to be certain. But I don't really see anything here that sticks out to me as being particularly high, considering the age and location of the property. So a touch high from an overall market view, but for a property of this age, seems to be right in line. 47% is very, very low for a property of this age.
And you also mentioned that there's no parking to this building, eh?
There's no parking to this building. Nope.
Okay. Summation, either party?
I don't know, Mr. Chair. Thank you.
No, thank you, Mr. Chair. I think we're good.
All right. Let's press on. Let's go a little further down the street. Is that 950 Burroughs Avenue? Mr. Valderrama, whenever you're ready.
Thank you, Mr. Chair. Next property has a file number of 22-1517. It has a roll number of 14022524000. The property is located at 950 Burroughs Avenue. We're dealing with the roll year of 2023, using reference date of April 1st, 2021. The assessed value is $3,157,000. The property is classified as a residential 2 with a taxable liability. The property is a residential apartment with 1 building, 2 stories. It has an actual and effective year built of 1969. It has 38 suites with 30 outdoor parking. It is zoned as residential multifamily. It has a land area of 31,986 square feet. plan area of 11,214 square feet, a basement area of 11,214 square feet, and a gross floor area of 33,642 square feet. On page 3 is the photo of the subject property. And on page 4 is the income valuation summary. Again, there are 38 units with an average monthly rent per unit of $847.78. It has a gross potential rent of $386,588. It has a vacancy rate of 3.2%, or $12,371. The effective gross income is $374,217. The expense ratio is 43.90%, or $164,281. The net operating income comes down to $209,936. Applying the capitalization rate of 6.65%, the capitalized income is $3,156,932, or $3,157,000 rounded. On page 5 are some rent comparables. The first one is located at 790 McPhillips. It has an average monthly rent per unit of $852. The second one is located at 620 McGregor Street. It has an average monthly rent per unit of $896. The third one is located at 229 McRae Avenue. It has an average monthly rent of $178. And the last one is located at 183 Euclid Avenue. It has an average monthly rent per unit of $1,036. On page 6 is the map of the subject property and comparable rents. On page 7 is the capitalization rate chart. On page 8 is the capitalization rate evidence. Beginning of page 9 to page 12 is the 2020 income and expense information for the subject property. And that's my presentation, Mr. Chair.
I thank you, sir. Mr. Story?
Yes, I have excuse me, just a few questions. Mr. Valderrama, did you look at the actual rents being achieved in this property for the purpose of our exercise today?
I just reviewed it and still went with the model.
Okay, but can we agree just very quickly on page 9 of your evidence? This is the INE that was submitted for the relevant year. And correct me if I'm wrong here, but they're suggesting that they're collecting $720.65 for a 1-bedroom and $833.20 for a 2-bedroom. Now that's a fair bit lower than what the model's suggesting, is it not?
Page 9.
Yeah.
720. Yeah, they're lower than the average monthly rent per unit of the model.
Okay, so I guess just as a methodological question, doesn't it make more sense to look to the actual rents that are contract rents being achieved that are in place than to look to proxy rents or comparables? Wouldn't that make more sense in this case?
Well, my comparables that I have supported the net rent that was produced by the model, so I went with the model on this one.
Okay, so did you review these rental comps that you've provided here today?
I chose them and I didn't specifically review them in detail, but I looked at the area and all that. So
yeah, okay, but okay, so I have a concern about that entry on Euclid. And again, can you confirm that is indeed a market? It just seems out of sorts to be over $1,000 for 700 square feet at the corner of Austin and Euclid. Are you sure that that's a market rent?
That's based on what was submitted to us. So that's the information I have here.
Okay, and then number 2, I know that property. That's in a superior location to ours. Is that a fair comment?
I think they're in the same market region or market area. So
okay, but this is the corner of McGregor and Inkster, so slightly different feel than this one on Burroughs and Battery or Burroughs and Agnes. Burroughs and Battery.
I would differ on that one.
Oh, okay. Okay. And Same question for the expenses. Did you make any attempt to stabilize the expenses based on what's being reported here on page 10, 11, and page 10 and 11 of your brief, and 12?
Again, I used the model on this one.
Okay. Mr. Chair, those are my questions. Thank you.
I thank you. Ms. McFadden?
I guess I'm just a little curious about the cap rate here at being 6.65 when the previous building that's 100 years old has a 6.5. Can you give me any indication of why 6.65 for this particular building?
It is a model-derived capitalization rate, so it's probably based on the location, size, and the age of it. That's all that I can see. Mainly, those are the three parameters. I'm not sure what the model is putting weight on with regard to that, aside from those three that I have mentioned. There could be more too.
Okay, thank you.
Thank you.
I thank you. Ms. Davidson?
Yes, I had a question a little bit on the cap rate as well. This is a private building? Like it's not social housing?
I'm just looking at the ownership of it. It looks like it is a corporation or a company. I didn't go into detail of whether it is a non-profit or for-profit, but it looks like the liability is taxable, so it looks like it is for-profit.
Okay, so would that impact the cap rate at all?
I don't think so.
Okay, and then my other question, on page 2, it's old, but you have a sale back from 2010. Was that an arm's length sale?
Right. I didn't look into that further because it is really a dated sale and it's back in 2010. So I wouldn't put too much weight on it if that's how I would. That's how I would approach it.
Okay, thank you very much. That's everything.
Thank you. Thank you.
I thank you. Mr. Story, your presentation.
Thank you, Mr. Chair. And Ms. Davidson, you're quite right. This is indeed a private market apartment. It is not social housing. It is a private rental. And again, it is at the corner. Well, it's at the corner of both Burroughs and Battery and Magnus and Battery. So I suppose I was correct with that. It's the city is suggesting a cap rate of 6.65. We think that's a little high. So in this case, we're going to suggest 6%. Again, southwest corner of Battery and Burroughs. This is what we'll call the Burroughs Central neighborhood. It's right at those railroad tracks. I know that the city lists those tracks as a negative, railroad adjacency as a negative factor, presumably. The property has 38 suites. There is adequate outdoor parking. Site size is 31,986 square feet. It's zoned RMFM, so multifamily medium. I've got an overhead view there of Magnus and Battery. So north end again. Okay, so ultimately, we have considered our baseline cap rate typically would be about 5.5%. That's the typical middle of the road for the Winnipeg apartment market. The city is applying 6.65. Again, that's modeled. I'm not sure how that was derived, but we're using 6%, and that's a slight adjustment for location. Now, some of these properties, like the one actually all the ones that we've seen previously today, would have from a site-specific basis, those would have more challenges in terms of location. This one is not necessarily ideal, but it's not. We're not suggesting it's the same as Charles or Selkirk or being on the corner of Burroughs and Saltern. But anyway, we have adjusted for condition. You'll see the interior photos. You can see that they're not renovated to a high degree. The property is built in '69. And location would be considered somewhat inferior, but ultimately on a site-specific basis, we've applied 6%. We think that's reasonable. I suppose that rail line adjacency is not a positive, but I don't know how we could necessarily calculate the exact adjustment for that. But ultimately, we feel very comfortable at a 6% cap. We've used the actual rents in place. So this is page 10. The model is very high when it comes to the actual rents in place here. You can see very clearly they are collecting as an effective gross rent $332,976. That is inclusive of vacancy. We do recognize that there's some laundry and parking income occurring to the owner. So our effective gross income is $349,316. Again, we've stabilized these expenses, and this is sort of interesting. Again, I'll look at the utilities. In this case, they run at 13.6%, which is what we would typically expect, even though that may be on the low end slightly. R&M is stabilized at $1,582 per door. So I guess suffice to say that the model is overshooting the rent and undershooting the expenses in this case, based on what we're seeing. Again, it is a private market apartment. It's professionally managed. Total expenses then are calculated at $197,515, giving us an expense ratio of 56.5%, leading to a net operating income of $151,800. With a cap rate of 6%, we calculate an overall value of $2,530,004, which we then, of course, round to $2,530,000. Page 11 is, again, our R&M breakout for you. And the balance of the brief, again, we have the statements that inform our position on the income and expenses. And I'd mentioned the condition. Now, because these are renting on the private market, we do have some marketing photos and marketing information. This is page 28. These are current. Call it Cheryl Manor. They sort of talk a little bit about it here. And on page 29, these are the marketing photos. So you can see we've got what we'll call utility grade carpeting. Those cabinets and countertops look to be from, well, it's called the 60s or the 70s. Flooring is very basic. So ultimately, they're not renovated to a high degree, but a 6.65 cap seems a touch aggressive in this instance. So we've applied 6%. Once again, based on the site-specific review of the income and expenses and applying a cap rate of 6%, we come to an indicated market value of $2,530,000. And that's my presentation. I'm open to your questions.
Thank you, sir. Mr. Valderrama.
I have no questions, sir.
Thank you. Ms. McFadden.
Mr. Story, you mentioned this and I didn't catch the page, but where are you getting the actual rent at $730?
Oh, sure. So if you follow me to page 16 of my brief, that's the income and expense for the year 2020.
Correct.
Yeah, and so that gives us our residential rent, rent reductions, the parking income, rental discounts, and then laundry and the other income items. And then everything in with the red notation are the inputs that we use in our R&M study. So our rental rate is actually built, or comes from the submissions of the owner. Oh, I think I see what you're saying. The question that I had for the assessor was based on the actual INE. Sorry, you know what? We don't have that page. But if you go to, sorry to flip around here, but if you go to the assessor's page 9, I suppose, that's the first page of that INE for 2020. And it shows the bedroom count, 23 one bedrooms, 15 two bedrooms. And it's showing the monthly rent for the one bedrooms at $720.65. And for the two bedrooms, it's $833.20.
Okay, thank you.
You're welcome.
I thank you. Ms. Davidson.
I have no questions. Thank you.
Thank you. Mr. Story, in your presentation, I'm looking at gross potential.
Yep.
But you've also added in laundry and parking.
Yes.
17,500. do you know whether the I'm taking that into consideration, and I'm looking also at the discrepancy between both parties' gross. So the city's $54,000 higher than you.
Yep. And that's I suppose that's the difference between the model and the actuals. You can see that laundry now. We don't average out the laundry or the parking. We use the most current year, but you can see that it's pretty typical that that parking revenue ranges, I guess, between $700 and call it $9,600 per year for for that horizon of 17 through 20, and through the same period we see 7,500 to about 9,700 on laundry. So we use the most current year, which are typically on the higher end, but that's appropriate. If you're purchasing the property, you should expect to for that income to accrue to you. But in terms of the city's modeled assessment, I don't know how they generate it. All we can do is look at the actuals, and this is if you were purchasing the property, sir, this is what you would look at. You would look at the actual income and expense, and this is how you would determine the performance of the property.
Mm-hmm. So, in your experience, is this a typical discrepancy between the model and actual?
Well, no. For this property, it's there's some oddities here. The rents are extremely high. The expenses are quite low, and then that cap rate is also extremely high. So I'm not sure what's happening with the model in this instance. I couldn't tell you. I have not sort of seen behind the curtain of how the model works. I don't know. But yeah, those actually all of those inputs are a bit odd to me. But yeah.
And in your estimate, a building that was built in 1969 and it is owned by, it's not social housing or anything like that. The expense ratio seems to be pretty high for.
No, I think that's about what I would expect to see. Something over. I mean, if it's high, it's a touch high, but I think at 56%, that doesn't give us any concern. Frankly, I think that's about what we would expect. So, and it's maintained. They're spending almost $1,600 a door on R&M, and so in terms of the expenses, there's really there's nothing here that strikes me as atypical. The utilities are frankly on the low side. Management is 5%. It looks to be, from my perspective anyway, sir, it looks to be in order.
And you think like the 6% cap rate is applicable?
Yep, absolutely.
Okay. Thank you. Summation, either party?
I don't, Mr. Chair.
Not for us, Mr. Chair. Thank you.
All right. Let's go to the next property, which is 195 Cathedral Avenue. Mr. Valderrama, whenever you're ready, you can take us through that property.
Thank you, Mr. Chair. Next property has a file number of 22-1891. It has a roll number of 14100123575. The property is located at 195 Cathedral Avenue. We're dealing with the roll year of 2023 using reference date of April 1st, 2021. The assessed value is $3,535,000. The property is classified as a residential 2 with a taxable liability. The property is a residential apartment with one building, 3 stories. It has an actual year built of 1929 and an effective year built of 1959. It has 32 suites with 4 outdoor parking. It has a commercial community zoning. It has a land area of 16,298 square feet, a planned area of 6,635 square feet, a basement area of 6,635 square feet, and a gross floor area of 26,540 square feet. On page 3 is the aerial photo of the subject property. Page 4 is the income valuation summary. And there are 32 total units with an average monthly rent per unit of $964.37. The gross potential rent is $370,318. It has a vacancy rate of 4.2% or $15,553. The effective gross income is $354,765. Expense ratio is 47.69% or $169,187. The net operating income comes down to $185,578. Applying the capitalization rate of 5.25% on the net operating income, the capitalized income is $3,534,819 or $3,535,000 rounded. On page 5 is the rent comparables. The first one is located at 707 Lila Avenue. It has an average monthly rent per unit of $1,061. The second one is located at 1075 Andrews Street. It has an average monthly rent per unit of $1,245. The third one is located at 390 Partridge Avenue. It has an average monthly rent per unit of $1,143. And the last one is located at 191 Cathedral Avenue, and it has an average monthly rent per unit of $989. Page 6 is the map of the subject property and comparable rents. Page 7 is the capitalization rate chart. And on page 8 is the capitalization rate evidence. On pages 9 to 10 is the income and expense for the subject property. And that's my presentation, Mr. Chair.
Thank you, sir. Mr. Story?
Yes, sir. Thank you. Okay, Mr. Valderrama, this property is almost 100 years old, the original build. Is that fair?
Almost, yes.
Okay. And it only has 4 parking stalls for 32 suites. Is that correct?
Based on our records, yes.
Okay. Now your work up on page 4, that's all modeled, correct?
These are all model parameters, correct?
Okay. Was there any review of the actual rents in this case?
I did attach the 2020 income and expense information on page 9, I believe, of my evidence.
Okay, can we agree then that the model is suggesting a much higher rent than what is actually being achieved in this property?
Around 17,000, I believe, for net operating income. It has an actual reported 168,000 for net income.
No, for the actual rents though, for the rents on a per door basis. The model, the potential net market income, potential net market rents that the model is suggesting are indeed higher than what's being reported in this case. Is that fair?
It is higher than the actual, yes, the 2020 at least.
Okay. Now I just want to look at your rent comps because in this case we are going to be disputing the rent that's being applied here. Firstly, so I have some familiarity with all of these. Just very quickly, in terms of the area, when we look at this is on page 5, on the rent comps, those first 2 numbers of the roll number, those indicate a neighborhood grouping, do they not?
I believe so, yes.
Okay, so we can agree that Leela, Andrews, and Partridge, those are in a different neighborhood by the city's model. Is that fair?
Maybe neighborhood. However, they are all within one market region, a bigger market region.
Okay, so 195 Cathedral, that's the corner of Cathedral and Main, right? On Main Street?
Cathedral. Yes, it is.
Right by Sudzers, the old dry cleaner. Okay, anyway, 707 Leela, though, that's the Hedges. That's across from Garden City Mall. That's a different area. Right?
Neighborhood, yes, different neighborhood, but they belong in one market region, is what I'm saying.
Okay, okay, but the rents are indeed different, and they are, and location is going to be a factor. So, and then also those 2 on Andrews and Partridge, those are sister buildings, correct?
Andrews and Partridge.
Right next to each other.
Correct.
Right?
Yes, they are.
And they're sister buildings.
They are next to each other.
Yeah, and those would be, well, you'd probably call that West Kildonan. more than, slightly different than the subject, correct?
The neighborhood would be different.
Okay, well, okay. And then in terms of the age of these properties that you're using, these are newer, to be certain. Those are actual ages. I know those properties, those are actual ages. They're not effective ages, correct? For your comps, except for 4?
Those are our, let me just double check. Effective year built.
Okay, but they're the same as the actual year built for those 3, correct?
If there are no changes or anything, any major renovations, then yes, they would be the same.
That's when those
actual
properties were
year
built, though, right? Okay. 191 Cathedral is the sister building to our subject, correct?
Sister building, they are close to each other, yes.
They're neighboring properties. They're exactly the same. If you look at the actual characteristics, they're mirror images. They're the same. They're sister buildings. Okay. But I looked into our files. Now that monthly rent that you're applying as a comp is also higher than what's being reported. So in terms of the average monthly rent, is that rent not inclusive of discounts, or how do you determine that? Is that an actual rent that's being achieved, or is that how those rents are being applied in this comp chart? Are those actuals, or where are those being drawn from?
These were just these were based on the submissions that we have on file.
Okay. 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 So then you would use the neighboring property, but you wouldn't use the rents in place for the actual property to determine the value of the subject. Is that fair to say? Am I getting the methodology correct from the city's perspective?
The average monthly rent for this subject property was produced by the model, and I have included rent comparables that may support the rent that was produced by the model, which in this case 989 is a really close one, and it supports whatever the model is achieving at 964.37.
Okay, and all of those comps, those would be the rents that they're permitted to charge would be guided by the RTB. Is that correct?
These are the rents that they're charging. So
Okay,
I'm assuming they're charging based on what the law is telling them to charge.
Right. Okay, I think I'll leave that there. Thank you, Mr. Chair. Those are my questions. I think you're on mute, sir.
Mrs. McFadden?
I have no further questions. Thank you.
All right. Ms. Davidson?
No questions, thank you.
All right. Mr. Story, Mr. Valderrama, was there ever, did you check permits on this building?
No, I wasn't able to check on the particulars on the permits.
So you don't know the renovations that maybe took place?
Well, putting a 30 years on the actual year built, it may have been a significant renovation.
Yeah. Okay. Mr. Story will light up that area. Mr. Story, your presentation.
Yes, thank you, sir. So once again, we've established we're on the corner of Cathedral and Main Street. Now this is on the east side of Main, just to be clear. It is a 3.5-story walk-up. It was indeed initially built in 1929, but it has had substantial work done to it. I remember this property from many years ago, and the current owners have done some work to bring it to a higher standard than what it had been previously. I have some photos on page 4. You can see there is no parking, unfortunately. And that's likely due to the vintage of the property. It's an older property. Sometimes we see this in properties built in this era. Now, the bones of the building, once again, are 93 years old. The city has applied a variant age of 1959, which seems fine. I mean, that's subjective, but we're not using that number necessarily as a be all end all, but we have used a pretty reasonable cap rate in this instance of 5.75. We've not made a large locational adjustment. Again, this is a North End property, but it is on the east side of Maine. That's Cathedral in Maine. That's getting into the what the realtors today would call Scotia Heights. So it's not quite the same situation as some of the previous properties that we looked at. It is masonry, which is good. So the building is older. It doesn't have any parking. It is in the North End, but given the work they've done here, we think that the cap rate of 5.75 makes sense. Now the rents are overstated by the market. There's no way around that. If you see what they're actually achieving on page 10, you can see, the city's suggesting 370, and even with the work that's being done, the high end of their capability is 336, 127. Vacancy has gone from a low of 3.5 to a high of 7.4 with an average of 6%. And you can see that there has been bad debt collection loss. 7.2% in 17 would be very high. But that seems to have stabilized at 0.2% in 2020. So we haven't made an adjustment on that basis, but we have applied a slightly higher vacancy than the assessor at 6%. Now, just to put that into perspective, proportion of 6% vacancy on a 32 unit suite is 2 units. So it looks higher, but frankly, it makes sense, and it's supported by what they're reporting. And as rents go up, we may see less, there's going to be some tension between rising rents and what the market is willing to bear. So again, we've provided you with the site-specific analysis of the property. 6% is reasonable. We have included the laundry and parking income. There are 4 stalls, I believe. So there's some parking income that's coming to them. Although I believe they also have a sort of a vacant lot down the street that may be coming from there, but regardless, we've included it because they've submitted it. So ultimately, our effective gross income is 331,605. The assessor is still a fair bit higher than us at 354,765. That's the model is suggesting that figure. In terms of the expenses, they're quite low actually in this property at only 46.7%. But we do note that they have done a fair bit of work, so there may be something of a holiday from the expenses based on the work that they've done. We have stabilized the R&M. Again, this is lower as well at 1,230, giving us a slightly lower expense ratio than the city at 46.7%. With the total expenses calculated as $155,012. So ultimately, our net operating income, based on the actuals, is $176,593. Again, we've used a cap rate that's it's somewhat low, but I think it's fair based on the fact that the property is in good shape. That leads us to an indicated market value of $3,071,189, and again, we round that to $3,071,000. We have our R&M breakout as we typically have shown you today on page 11. That's included, and just to see the interior photos from the owner's marketing, those begin on page 25. So you can see there are indeed some of those sort of heritage elements. You've got the brick fireplaces. They're decommissioned, but they're there. They've spruced them up. So there they are for your perusal. We've not used a higher cap rate based on the fact that the property is it is indeed in good shape. It is an older property, but 5.75 is just a touch higher than what we would consider the average of 5.5%. So ultimately, we do respectfully submit that our value of $3,071,000 be accepted by the board here today, and I'm open to your questions.
Thank you, sir. Mr. Valderrama.
I have no questions, sir.
I thank you. Ms. McFadden.
I'm looking at page 20 of your brief, Mr. Story. where the owner is indicating that the gross potential rent is actually $349, $693 if it's 100% rented up.
At 100% occupancy. Yeah.
But you're
Three-
using 36.
Sorry, let me just. Right. Okay. So if you go to, on my workup, there's a rental discount. So they are permitted by the RTB. I'd mentioned the RTB's guidelines. So they are permitted to charge that potential gross rent item on my top line, but they also record discounts. So the market will only bear a certain rental rate. So despite the fact that they're permitted to charge a certain rate, they have to discount that back to what the market will bear. So those potential gross market rents on page 3 of my workup line 3 on page 10, those are the actuals, and any delta between the potential and what they're permitted to charge and what they're actually charging is based on discounts, which are also recorded in their statements.
Okay, thank you.
I thank you. Ms. Davidson?
Just a quick question on your vacancy. Yours is higher as a percent than the city's. So is yours based that subject stabilized? Is that like stabilized actuals?
Oh, yes, actually, yeah. So if you look again, so just go through this very quick. On page 10 of my workup, you can see that in 2017, the vacancy was 3.2, but the collection loss, so that's bad debt, and that's chasing bad debts and collection, so that's non-payment, so to speak, is 7.2%. That's very, very high. And that would give us you some pause. That's over, 11.4%, or at 11.4%. 2018, we have 3.5% vacancy. 2019, that vacancy jumps to 7.4%. But we also see that the rents are, they increased between 19 and 20, and we see that the vacancy is stable at about 7.4, 7.3. The average vacancy between 18 and 20 is 6%. So we have applied 6%. And again, just to put that into relative context, with 32 units, 6% vacancy is 2 units vacant. So yes, that's what we've applied. And that is based on stabilized actuals over that horizon of 18 through 20.
This, I guess, isn't relevant, but why would the bad debt be so big in 2017?
I'm not sure. To be honest with you, I'm not sure. That's what they've collected. That's what we've reported from the income and expenses. But I didn't look into it. But that is high. But again, we didn't include that here. But not sure. It may have been pre-reno. It may have been a different. Again, I'm not sure. The rents are also high. So sometimes when we see higher rents, we'll see higher vacancy, and we may see higher collection loss. But that's a good question. I didn't investigate.
Okay, thank you very much. That was all.
I thank you. Mr. Story, have you talked to your client, the owner, at all?
About this property? No, not specifically about this property.
No. So you don't know what I know there was a lot of work done here.
Yep. No, it's in good shape. And I remember this property from many years ago. It was not in this shape. So they've done a good job working on it. But again, as we always point out, when we have a property where the foundation is still from the 20s, and so it is an older building, but it's a renovated building. And I think we've been very fair in applying a cap rate that's a quarter point higher than what would be typical if it were indeed built in, say, the late 60s or the 70s or some such thing.
So you can't tell, do you know anything about the permits that were taken out, or if they were taken out?
I'm not sure. I can't speak to that. I didn't look into the permits. We've just looked at the income, and we've just simply done the income analysis.
I know it's done, a heck of a makeover, that's for sure.
Yeah, that's good.
Yeah. Summation in either party?
I don't have.
No, we are good, sir. Thank you.
All right. So let's go to 200 Charles Street. Mr. Valderrama, whenever you're ready.
Thank you, Mr. Chair. The next property has a file number of 22-1918. It has a roll number of 14020030000. The property is located at 200 Charles Street. We're dealing with the roll year of 2023 using reference date of April 1st, 2021. The assessed value is $497,000. The property is classified as a residential 2 with a taxable liability. The property is a residential apartment with 1 building, 2 stories. It has an actual year built of 1910, an effective year built of 1940. It has 10 suites with 3 outdoor parking. It is zoned as a residential 2 family with a land area of 7,120 square feet, a planned area of 4,322 square feet, a basement area of 2,615 square feet, and a total gross floor area of 11,259 square feet. Page 3 is the photo of the subject property. And on page 4 is the income valuation summary. Again, there are 10 units with an average monthly rent per unit of $651.56. The gross potential rent is $78,187. The vacancy rate is 3.2%, which is $2,502. The effective gross income is $75,685. The expense ratio is 56.62%, which is $42,853. The net operating income comes down to $32,832. Applying the capitalization rate of 6.6% to the net operating income, the capitalized income is $497,455, or $497,000 rounded. On page 5 are some rent comparables. The first one is located at 291 McCrae Avenue. It has an average monthly rent per unit of $664. The second one is located at 259 Church Avenue. It has an average monthly rent per unit of $814. Third one is located at 283 Mountain Avenue. It has an average monthly rent per unit of $783. And the last one is located at 401 Salter Street. It has an average monthly rent per unit of $697. On page 6 is the subject property and comparable rents. On page 7 is the capitalization rate chart. On page 8 is the capitalization rate evidence. And beginning of page 9 up to page 11 is the 2020 income and expense information for the subject property. And that's my presentation, Mr. Chair.
I thank you, sir. Mr. Story.
Yes, thank you, sir. Mr. Valderrama, can we agree this is once again we're back in the heart of the North End here on the corner of Charles and Magnus. Is that fair comment?
Charles and Magnus. Yes.
Okay, and it's social housing, this property, correct?
Just by looking at the ownership, I would have to agree that it is.
Okay, and it was built in 1910, correct?
1910 is the actual year built.
And it wasn't built initially as an apartment. This is a call it an adaptive reuse. Is that fair?
I'm not sure of the history of this.
Okay, so you're not aware then, I guess, that it's grade 3 heritage as a designation?
I don't have that information in my evidence.
Okay, and then once again, does the model consider heritage designation? Does it consider? Okay, that's my question. Does it consider the heritage designation?
I believe I answered that, so I'm not sure how the model reacts if it has a heritage status.
Okay, and you have included the income and expenses. Now the income is going to be very low, but did you look at the expenses and compare them to the model, or have you simply deferred to the model for today's exercise?
I went with the model expense rate of 56.62%.
Thank you, Mr. Chair. Those are my questions.
I thank you. Ms. McFadden.
I have no further questions.
I thank you. Ms. Davidson.
I have none either, thank you.
I have none. So, Mr. Story, your presentation.
Yes, thank you, Mr. Chair. So as we've established here, this is 200 Charles. This is the southwest corner of Charles and Magnus. It's in the north end. Now, this property I'd mentioned, it does have heritage status. It's grade 3 heritage status, which is actually the, well, from the older designations have grades, and grade 3 is actually the most restrictive, as it would turn out. The property was initially built as the North End Police Substation. So it's an old police station in the North End from 1910 that has been converted to a social housing apartment building. It has 10 units, 6 one-bedroom suites and 4 two-bedroom suites. It was abandoned, I note, from 1967 through 1990. Okay, it was acquired by WHRC in 1990. So ultimately, we've applied a 7% cap rate. This is a very, very unique property. It does have grade 3 heritage. It is wood frame. It's built in 1910. It has very basic suite finishes, no central air, of course. It's in the north end. This is not, well, suffice to say, this is not the same as well, Cathedral and Main Street. This is Charles and Magnus. We have a low number of suites, which is not ideal. Our expenses then split across a smaller number of doors, which would be tantamount to more risk. So ultimately, a cap rate of 7% makes sense in this instance because of the very, very specific nature of this property. On page 11, we have accepted the actual rents. The city is suggesting 78,187, and that's fine. Now, if we were to look at the actual rents, you'd probably be, well, on an RGI basis, you're probably somewhere in that $350 per door rate. So again, just to be clear, we would not use the rents that are being recorded here as they are geared to income and would be far below market. Our effective gross income then is the same, but we do recognize, well, we've got higher R&M on a per door basis at $2,030. Utilities run on the higher side at 23.9%. But all that to say that we have actually capped the expenses when we calculate the actuals, and what's going on here. It's 80.2%. And that may be some function of the current use, or it may be some function of the fact that the property has been adapted. But ultimately, we're using 65%. And again, for a building that's over 100 years old in this location with this use, that makes sense to us. So our NOI is $26,490. So it's lower than the city. Oh, and actually, I said 7%, but I see that we've adjusted here to 6.75. So that's that's fine. But no, actually, that's a bit low. But ultimately, our value that we've submitted here, I'll stand by it at $392,441. And again, that's based on 65% expenses and a slightly higher cap rate than the city. So we are suggesting $392,441. I apologize for the typo in that previous page. So that is my presentation. I suppose I have the R&M included for you, but ultimately we are capping those very, very high expenses. I have some information for your interest on page 16. You can see that when the property was acquired in when it was acquired, it was then added to the Heritage Resource List and given a grade 3 designation. That's on page 16. That's the North End Police Substation. I have the short form submission, and again some information regarding our position on how we ought to apply slightly elevated, or in some cases fairly elevated cap rates for social housing. Page 36 shows you the exterior of the building and some exterior photos, and ultimately that is my presentation. We are requesting a value of $392,000 based on page 11. Thank you very much.
I thank you, Mr. Story. Mr. Valderrama.
I have no questions, Mr. Chair.
I thank you. Ms. McFadden.
I have no questions. Thank you.
Ms. Davidson?
Could you just repeat what you said, you're asking for an assessment?
Yes, so we had made an adjustment. So you can see on page 2, it's at 378, but that's based on a 7% cap. I adjusted it on page 11 to 6.75. So ultimately we are requesting 392,441, rounded to 392. And again, that's based on an NOI of 26,490. So it's 392,000.
Okay, so 392,000 and a 6.75% cap, right?
That is correct. Yes.
Thank you.
Thank you.
Thank you, Mr. Story. Once again, Manitoba Housing expense ratio 65%.
Winnipeg Housing, but yes, they're running, even when stabilized, they're running north of 80%. So 65% is what I've capped it at. I think that's reasonable. Again, it's a very old building. It used to be a police station, so it's been reconfigured, and it's in based on the area, the tenancy, and the age, 65% would be the where I would cap those expenses. Yeah.
I thank you. Summation, either party?
I don't have any, Mr. Chair. Thank you.
I think we are good, sir. Thank you very much.
Okay. Let's go to another one on Charles Street, which is 480 Charles Street. Mr. Valderrama, whenever you're ready.
Thank you, Mr. Chair. The next property has a file number of 22-2461. The property has the roll number of 14042177100. It is located at 480 Charles Street. We're dealing with the roll year of 2023 using reference date of April 1st, 2021. The assessed value is $9,219,000. The property is classified as a residential 2 with the liability of taxable. The property is a residential apartment with 1 building, 11 stories. It has an actual year built of 1970 and an effective year built of 1980. It has 104 suites with 9 indoor parking and 49 outdoor parking. The property is zoned as residential 2 family. It has land area of 36,483 square feet, a plan area of 6,814 square feet, a gross floor area of 74,954 square feet. On page 3 is the aerial photo of the subject property. And on page 4 is the income valuation summary. Again, there are 104 units with an average monthly rent per unit of $894.73. The gross potential rent is $1,116,623. It has a vacancy rate of 3.2% or $35,732. The effective gross income comes down to $1,080,891. Expense ratio is 43.28% or $467,810. The net operating income comes down to $613,081. Applying the capitalization rate of 6.65%, the capitalized income is $9,219,263 or $9,219,000 rounded. On page 5 are some rent comparables. First one is located at 790 McPhillips. It has an average monthly rent per unit of $852. The second one is located at 620 McGregor Street. It has an average monthly rent per unit of $896. The third one is located at 229 McRae Avenue. It has an average monthly rent per unit of $878. And the last one is located at 123 Sutherland Avenue. It has an average monthly rent per unit of $777. On page 6 is the map of the subject property and comparable rents. On page 7 is the capitalization rate chart. On page 8 is the capitalization rate evidence. Beginning of page 9 up to page 12 is the 2020 income and expense information. And that's my presentation, Mr. Chair.
I thank you. Mr. Story.
Yes, sir. Just a quick question. Okay, so, Mr. Valderrama, very quickly, what we're calling indoor parking here, just so we're all clear, it's not actually indoor parking. It's this is a high rise, and at the back of the building, there's sort of these little slots that the cars can drive in under the building. But it's not. It's covered on three sides, but it's not actually indoor parking. Correct?
I didn't inspect the property, so I wouldn't be able to answer that question.
Okay. Okay. And really, I think for the most part, we're kind of just talking about expenses here. So we'll just get to that. Did you review the actuals being recorded?
Yes, I did, and I still went with the model expense rate of 43.28%.
Okay, but that's fine. But the actual expenses that the model is suggesting are 467,810. And can we agree that since 2017, we've seen expenses that range from, well, let's say $526,000 a year at the low to up to $591,000. So the expenses have been consistently high in the last, call it 4 years. Is that fair comment?
I only have the 2020 on my evidence, so I wouldn't be able to comment on the previous years.
Okay, but when putting your evidence together, you had access to 17, 18, 19, and 20. Did you review any of those statements? And just as a further question, did you make any attempt to stabilize those expenses?
I have only 2020 on this one, so I only reviewed the 2020.
So you've not. So just to be clear, you've not reviewed them prior to submitting the evidence. Is that fair?
I only reviewed 2020 income and expense information.
Okay, you reviewed 2020, but then just again, and not to belabor this, but in 2020, the expenses are a fair bit higher than what the model is suggesting. Quite a bit higher, correct?
Looking at the model and the actual, yes, the actuals are still higher.
They're over $100,000 higher than the model, correct?
467,000 on the 2020.
2020s are 591,000.
It's 546,000 on the 2020. Yeah, over 100,000.
Okay, those are my questions, Mr. Chair. Thank you.
Thank you, Ms. McFadden.
Don't have any further questions. Thank you.
I thank you, Ms. Davidson.
I have no questions. Thank you.
Thank you. Mr. Story, your presentation.
Yes, thank you, sir. Okay, so we are at the corner of Church and Charles. Sorry, just very quickly on page 2, that's a clerical error on my part. That highlighted section that says 10.8 million should indeed be 8,290,000. Apologize, that's likely a speed error on my part in the mad rush to get these documents in. But the correct value is in the workup. So ultimately, we are at the corner of Church and Charles. It's a high rise. It's 11 stories. We've used the actuals once again. The assessor is suggesting a cap rate of 6.65. We've used 6.5. So slightly lower. So I'll leave that in your hands. But we think that 6.5 is reasonable. If that cap rate is indeed higher than what we would typically see, I will point out again that we're on the corner of Church and Charles. So we do have some locational issues here. Okay, so ultimately, if you follow me please to page 10, we have included the potential gross rents on the top line. And you can see the discounts are substantial. So they're permitted to charge by the RTB a higher rent. But again, the market will only bear so much, and that's likely, well, quite frankly, it's the corner of Church and Charles. So you're not going to, you wouldn't expect to achieve necessarily the higher end of the rent. This is what the market will bear. These are the actuals. So we've used the most recent rent at $1,091,524. We've used the low end of the vacancy. Now it's interesting. The vacancy in 2020 is 2.2. Collection loss is 1.4. Average vacancy once again citywide is 3.8%. But these rents are discounted to what the market will actually bear. So using 3.2 makes sense. And I noted sort of interesting. The average vacancy over that time horizon is actually 2.9, with the bad debt at 0.9. So that's right in line with the average city vacancy of 3.8. However, we have used 3.2%. So there should be no dispute there between us and the assessor. We have recorded the laundry and parking as well as miscellaneous. So ultimately, our EGI, effective gross income, is $1,113,136. In terms of the expenses, once again, we've used the actuals. I pointed out in my questioning of the assessor that the model expenses are very low here. I don't know what's giving rise to that. I don't know why that would not have been adjusted, given the fact that there is this very substantial delta. But we have stabilized these expenses as we have for all of the properties where we have these fulsome income and expense reports. And that's been provided to you here. Once again, nothing is really out of the ordinary. This is a professionally managed property. Expense or the utilities run a touch high, but that's what they are. They're 18.6% of EGI. And again, it is a professionally managed property. So the expenses, once stabilized, are $574,243. You can see that the average over those years is $571,900. So we're right on where we should be for those expenses. Expense ratio is 51.6%, which makes sense. And again, we've used a slightly lower cap rate than the assessor, ultimately leading us to a value of $8,290,660. So we do request a value of $8,291,000. I suppose I think I have $8,290,000 elsewhere, but $8,291,000 would be the correct figure. Again, that's based on a NOI of $538,893, cap rate of 6.5. Leading us to a rounded value of $8,291,000. Once again, as you've seen a number of times here today, we've included our R&M study. Those are all itemized and provided for you. We have provided the income and expenses with our red notation showing you how we've determined our position. That's on page 16, starting on page 16, I should say. And then in terms of the condition, we can see the interiors from the marketing photos starting on page 28. And you can see some interiors marketing purposes on page 29. So ultimately, we think that our value of $8,291,000 is quite fair. And we do respectfully submit that the value for this property be adjusted to $8,291,000. And I thank you.
I thank you. Mr. Vanderramba?
I have no questions, sir.
Ms. McFadden?
I have no further questions. Thank you.
I thank you. Ms. Davidson?
No questions. Thank you.
I thank you. Summation, either party?
I don't have any. No,
So
sir.
thank you, sir. I think we're good. Thank you very much.
Let's go to the last property that we have, which is 301 Church Avenue. Mr. Vanderrama?
Thank you, Mr. Chair. The last property has a file number of 22-2163. It has a roll number of 14043173000. The property is located at 301 Avenue. We're dealing with the roll year of 2023 using reference date of April 1st, 2021. The assessed value is $965,000. The property is classified as a residential 2 with a liability of taxable. The property is a residential apartment with 1 building, 3 stories, an actual year built of 1913 and an effective year built of 1915. It has 22 suites with 5 outdoor parking. It is zoned as a residential 2 family with a land area of 6,536 square feet, a planned area of 3,226 square feet, a basement area of 3,226 square feet, and a gross floor area of 12,904 square feet. On page 3 is the aerial photo of the subject property. On page 4 is the income valuation summary. Again, there are 22 units with an average monthly rent per unit of $572.94. The gross potential rent is $151,256. The vacancy rate is 3.2%. or $4,840. The effective gross income is $146,416. The expense ratio is 56.16% or $82,227. The net operating income comes down to $64,189. Applying the capitalization rate of 6.65% on the net operating income, the capitalized income is $965,248 or $965,000 rounded. Page 5 are some rent comparables. The first one is located at 1002 Selkirk Avenue. It has an average monthly rent per unit of $665. Second one is located at 423 Burroughs Avenue. It has an average monthly rent per unit of $556. The third one is located at 607 McGregor Street. It has an average monthly rent per unit of $679. And the last one is located at 611 McGregor Street. It has an average monthly rent per unit of $795. On the next page, page 6 is the map of the subject property and comparable rents. On page 7 is the capitalization rate chart. Page 8 has the capitalization rate evidence. Beginning of page 9 up to page 12 is the income and expense for the year 2020 for the subject property. And that's my presentation, Mr. Chair.
Thank you, Mr. Vallarama. Mr. Story, your questions?
Yep, very quickly. Mr. Valderrama, just one thing I noticed. I see the actual year built is 1913, and the city's applied a variant age of 1915. Sorry, 1913 is actual, 1915 is the variant. What would give rise to an adjustment of only 2 years? Any idea?
I have no information on that one, Mr. Chair. Sorry.
Okay, and we can agree, of course, that we're now, again, we're west of Main. This is Church and Aikens, correct?
Yes.
Okay, and does the model consider the location? Is there an adjustment for the location, or is it simply age in this for this valuation? Yeah.
For cap rate, location is also included.
Okay, and the low parking ratio, is that considered in the cap rate?
I am not sure. No, I have no information on that one.
Okay, and what about the suite mix? They're all one bedrooms, correct?
They're all one bedroom, correct.
And does the cap rate consider that?
I'm not sure. No, I don't think it does.
That's fine. No, it does not. Okay. Thank you, Mr. Chair. Those are my questions. This is just going to be a cap rate issue, so I'll be speeding.
All right. Ms. McFadden?
I don't have any questions. Thank you.
I thank you. And Ms. Davidson?
Just a quick question, because, I heard what was just said. The assessor, you're using 6.65 cap rate for the oldest property that we've seen today, like basically a First World War property. Thought that age was significant in terms of the establishment of a cap rate. And also it's only 22 suites.
Yeah, it's a model derived cap rate. So one of the bases would be age, and then a couple of them would be location and the size of the structure or the building. So I'm not sure if any what other factors were in play or were considered by the cap rate in putting out a 6.65% capitalization rate. But in terms of the effective age of this one, I think it falls in line in that category. So it should, I find it okay.
Okay, so it makes sense, like compared to the other ones we saw today.
Yes.
Okay, thank you. That's all my questions.
Thank you.
I have no further questions. Mr. Story, like you say, the floor is yours, and it's just a question of more or less cap rate. So deal with it.
Yeah,
the floor is yours.
Thank you, Mr. Chair, and thank you, Ms. Davidson. It is indeed a World War I era property. I hadn't put it in that context before, but that is indeed what we have here. So 3.5-story walk up. Again, we are at 301 Church. I've provided some photos for you. You can see the front on page 2, and then some views from the alley on page 3. You can see those wooden stairs in the back. and just some general photos of the rear and the side and front of the building. So again, that's the northeast corner of Aikens and Church, built in 1913. It has 22 one-bedroom units. I think I heard the assessor say that the model doesn't account for suite mix or the fact that it's all simply one-bedroom suites. We would see that as a negative. I'd mentioned at the beginning our cap rate study. That is one of the factors that we consider. Of course, we consider location. We consider the age. So ultimately, we have used a 7% cap rate. That is going to be the higher cap rate that we've used today. And that makes sense based on age, based on location, based on suite mix, based on lack of parking. So ultimately, this comes down to cap rate. We're using an NOI of 62,241. The assessors or the model has suggested 64,189. You can see that we're slightly higher on our expenses. The R&M is $1,016 per door. Utilities running at 18.9%. Again, professionally managed. This is an older building. That's sort of the reality. Expenses are typically higher in buildings that are older. So I won't belabor that, but I'll just ask Mr. Chair that some of my comments regarding R&M and these matters carry forward. But our NOI, suffice to say, is reasonably close based on the actuals. The main point of contention here is going to be that cap rate. We're suggesting 7% makes sense. If the very high end, as I mentioned in the first property, if the very high end of the assessor's model goes to 7.4%, then if we have a property that's much older in an area that might be considered inferior, would certainly be considered inferior in the eyes of the market, where we have a suite mix that is not typically desirable, and where we have a dearth of parking, then I think a 7% makes sense. And it is, again, the higher cap rate that we've seen today, and that all ties together, I think, nicely. So ultimately, our request today is $889,000. You have our work up. You can see, actually, I've got some interior photos, marketing photos. I'll leave those with you. Those are starting on page 34. You can see they're maintained, but call that a basic standard. Bathroom looks pretty slim, but again, it's very old property. I think I will leave it there, Mr. Chair. And again, we're requesting $889,000 for this property, and I'm happy to take your questions.
Thank you, Mr. Story. Mr. Valderrama.
I have no questions, Mr. Chair.
I thank you. Ms. McFadden.
I have no questions. Thank you.
I thank you. Ms. Davidson.
I have none either. Thank you.
Alrighty, I thank you. Mr. Story, I thank you very kindly for your presentation and results very soon. You have a good day. Mr. Valderrama, thank you for your presentations, and you have a good day. We have heard all the items scheduled, and this hearing is now adjourned. Gentlemen,